This is kind of different from what we normally do. We're face to face, and as Cody said, we do a radio show every week, and I think, as you can see, Cody and I have faces that are meant for radio. But he wanted me to come on, wanted me to share with you some of the market outlook this week, some of the crops that in the livestock that we cover every week on the radio, and he really wanted me to focus heavy on the livestock end of it, and that's exactly what I've got for you. I'm going to share my screen here with you, and we will get this thing to moving quick as I can get this. Now, if you can't see this, please speak up and let me know. This is, I don't know, Cody, can you see my screen now?
Yeah, you're good, Blake.
I'm good to go. Okay. All right. Well, we're going to kick this thing off because it is rather lengthy. There's a lot of things going on in the markets right now, and I do want to get to cattle. That'll be the last thing that we'll cover. We'll run right through the crops real quick. Looking at wheat, condition reports came out this week, and the wheat conditions are sliding, and they have been for the past 3 weeks. Nationwide, 54% rated good to excellent. It was 57% last week, rated in the top 2 categories. Bottom two categories are poor to very poor, 15% rated there this week. It was 13% last week. So as you can see, the top 2 categories are dropping and the bottom 2 categories are coming up. Looking at Kansas, 40% rated good to excellent this week. It was 46% last week and 50% 2 weeks ago. On the low end, 20% right now in Kansas rated poor to very poor. That's coming up. It was 15% last week or 18% last week, 15% 2 weeks ago. So you can see Kansas is getting a little bit worse off. Oklahoma following the same trend, 62% rated good to excellent. It was 75% good to excellent just 2 weeks ago. So Oklahoma's really come down. 14% rated poor to very poor. That's up 10 points from 2 weeks ago. So Oklahoma's moving fast to the downside. Texas, 57% rated good to excellent. We're down only 1 point from last week, but it was 66% good to excellent 2 weeks ago, 13% poor to very poor. That's up a point from last week and up a few points, 5 points from 2 weeks ago. So nationwide, crops looking a little bit worse, getting a little bit of stress in there. Good to excellent condition coming down, poor to very poor conditions coming up. Wheat prices right now showing a little bit of weakness. We got a couple of things going on. We got rain across Europe, and that's easing some concerns about crop stress over there. And also we got the world wheat harvest that started up, and we're kicking it off in India, Pakistan, Eastern Asia, and North Africa. By the time we here in Texas and Oklahoma start harvesting, about 25% of the entire world's wheat crop's going to already be out. So we're starting to feel harvest pressure even right now worldwide. And you look at world estimates coming out of the International Grains Council, they're projecting record production, record supplies, record use, record ending stocks. I mean, everything's just up this year in terms of wheat. World production coming in at 28.2 billion bushels, supply coming in, total supply being 39 billion, use is 27.5. And as you can see, you take, world supply minus use, that's going to give us our ending stocks. That's what we have to carry over for next year, 11.5 billion. Again, all of those are records. Looking at production in some of the specific countries, the European Union is the world's largest producer of wheat. Production of soft wheat's forecasted lower by 176 million bushels. They had some pretty bad planting conditions over there, and that's reduced some of their acres, so that's where some of the bushels have gone. They really cannot afford any type of major weather event right now that decreases production. They just cannot handle it right now, the European Union. India is the third largest wheat producer in the world. Their harvest is delayed right now because of a shortage of workers and equipment, and that's really due to the COVID-19. It's just reduced the amount of workers that they have to get that wheat crop out. Rains have reduced quantity as well as quality, but they're still projected to have a record crop over there in India if they can get it out. Russia, the Ukraine, and Kazakhstan, all over there in the Black Sea region. Production out of Russia is going to be between 2.85 and 2.94 billion bushels. That's an increase from last year, somewhere between 150 and 240 million bushels. Last year, they produced 33% of the world's wheat. So them coming up just gives them a little bit more of a foothold in terms of world wheat production. Prices down the road. Russia has stated that it's going to shut down its exports once its export quota has been reached, and that should happen in May. The Ukraine's exportable supplies are also reported to be close to depletion as well. So Russia's not going to have the big stronghold on exports moving forward that they have in the past. Now, there's questions as to whether or not they're going to open them back up once they harvest this next year's crop. But some are suggesting they're gonna limit them even next year. So they're trying to build up their reserves over there. And by them pulling out of the export picture, if they do in fact pull out and stay out, it's going to lend some price support not only for this year but also next year for wheat prices. Here's the wheat chart that we have. This is the July Chicago wheat. You can see a little bit of weakness here in the past few days. Want to highlight that it looks like we've been moving kind of the downside in a channel, and that's a pretty wide channel in there. We're looking at going from about 525 up to 560, at that midpoint there. So that's a pretty wide channel, but right now that's just how this market's moving. It's moving in a wide swath, but it is moving overall to the downside. Hopefully this 520 is going to hold. Right now, it's anybody's guess as to what's going to happen. And whenever you start looking at these charts, where these bottoms are going to be, because this COVID-19's really shook everything up. You can tell from, just in the most recent weeks how erratic these prices have been. And we're going to see that across the board with all of these commodities, but it's just erratic is the only thing that can describe it. I've drawn a line in here about the time, about early March, whenever COVID-19 really started hitting the U.S. And look at the difference here between pretty much a smooth up and down motion that we have from March back, and from March forward, it's just really, it's been all over the place. So where this price is going to go, it's kind of hard to call right now. I'm saying anywhere between 520 and 570, and I know that's a 50-cent range in there, but I'm hoping that 520 will hold. If it does, I think 570 right now, given the world picture, is going to be all this market's going to be able to handle. Looking at corn, we are in the middle of planting season. 27% in the ground nationwide. It was at 20% last week. And as we know, last year, kind of hard to compare it to last year because of all the rain we had. But last year at this time, we were 7% complete. So we're running ahead of schedule or ahead of normal right now. Here in Texas, 67% done. It was 62% last week. We're leading the nation in terms of our planting pace here in Texas. The Corn Belt, they are started. They're off and rolling in the big three, the I states. Illinois is 37% done. They picked up 6 points from last week. Indiana's 18% complete. They picked up 7 points. Iowa's 39% complete. They picked up, they gained a lot of ground. They gained about 19 percentage points. Whenever they get good weather up north, we know that they can roll and they get a lot of corn planted in a quick time. I think it was just a couple of years ago, we saw 50% of the nation's corn crop got planted in just 1 week's time period. So right now we're off to a good start. Everything's rolling, and that's going to create a little bit of price weakness. Here you can see the 18 states in terms of their planting pace. You can see what's going on in each one of those states. Pretty much everybody's running for the most part ahead of schedule. You do have some outliers in here. You can see Nebraska is sitting at 20%. Normally they're at 16. Just above them, Missouri, they're at 25% done this week. Normally they're at 46%. So you do have a few outliers in here, but for the most part, everybody's running ahead and running really, really well. Looking at corn, favorable weather's playing a role in these prices, as well as the oil prices. Corn's still following oil. The weather is allowing acres to go in faster than normal. USDA is suggesting right now we're going to have 97 million acres of corn. That's up 8% from last year. Before this month's supply-demand report, the trade was kind of thinking we'd have about 94 million acres. So that was a shock to the system, and that's what really had us pick up the pace in terms of dropping to the downside with prices, because we're just expecting getting more acres. And we all know generally whenever the Corn Belt gets rolling, if farmers have good weather up there and they're planting corn, they're not going to switch over to beans. They're going to keep planting corn. So as long as this weather holds out and they're able to roll, that's going to be a negative in terms of corn prices in the short term. Also, 30% of the annual corn crop goes to the ethanol industry. So oil prices continuing to struggle, that's going to be like a lead weight on these corn prices, at least for right now. When we get into the summer months, then we can start talking about some weather issues. But right now, it's just really not looking that good in terms of corn prices. Exports are improving. Corn inspections in the week ending April the 23rd, they came in at 1.08 million metric tons. That's up from 698,000 tons the previous week. We are running behind where we were last year. Last year at this time, at that week, we were at 1.37 million metric tons. So we are still behind. Total inspections to date, we've inspected 22.3 million metric tons coming out of the U.S. of corn. Last year, by this date, we had inspected 34.7 million. So corn's just not moving on the export stage. You would think that would start turning around given where corn prices are, and that some nations would just start buying because we're more competitive now. Hopefully that is going to turn the corner, and hopefully these weekly inspections being up, hopefully that's a signal that, hey, we're starting to sell more corn just because we're more competitive. We do have a long way to go to catch up to last year. Here's the corn chart, and there's not a lot that you can say about this thing. This morning, it was sitting at 331 3/4. It was up a little bit, but it's just tracking that downtrend that's been going on really since January, but it really picked up speed come middle part of February. It just started going downhill and going downhill quick. And you can see about the middle there between March the 9th and March the 23rd, everyone started getting a little bit worried about those planted acres. And then on the 31st, USDA came out and said 97 million. And that's whenever we had the big drop down, and we've just been eroding since then with this coronavirus. Looking at beans, planting progress is about 8% in the ground right now. 4% is our 5-year average, so we're running ahead. Louisiana, Mississippi are leading the way. They've both got over 30% in the ground. And the Midwest, where we see a lot of bean acres going in, they're just now getting underway. They are moving fast with the good weather, and they should really start showing some good numbers probably starting next week. Here's the planted acres report that we see coming out of USDA that was released on Monday. You can see Illinois, Indiana coming in 11% complete. Up in Michigan, they're 4%. They're just getting rolling up there. Everything else is kind of, your fringe states that are coming out. Your big players are just really getting off the ground. Looking at exports, we finally got some sales to China this past Friday. It was announced 136,000 metric tons, for delivery for this current marketing year. This marketing year will be over in September. Rumors are is that more larger purchases are possibly coming. I think that price rallies, we're going to have to see those materialize before we're going to see a real run up in prices. I think that those rumors have to become fact before you're going to see the market come in and really start pushing these bean prices up. But the good news is we did get a sale to China. Mexico came in also, bought 125,000 metric tons. 39,000 are going to be delivered this marketing year, and 86,000 metric tons will be for next marketing year, which will be September on. That's whenever those beans will be delivered there to Mexico. Total inspections looking at for the week ending April the 23rd, just nearly 556,000 metric tons were inspected. It was 551,000 metric tons the week before, and 507, nearly 508,000 last year at this time. So we're moving more beans on the market looking at just this week. Year-to-date inspections, which is September forward, we've inspected so far 33.5 million metric tons of beans, 31.5 million metric tons last year at this point. So we are moving more beans on the market. It makes sense because China now can be a buyer, and they've made a couple of purchases in here. We're more than price competitive whenever it comes to beans. So I think that that's one reason that we're seeing that number up from the depressed levels last year whenever we had the trade war with China going on. Here's the price action for soybeans this morning. It was sitting at 837 and a quarter. You know, weakness from December on. It has shown some bright spots, but still we're tracking this downtrend. You know, that market just comes up and it hits that red line and just continually just falls off. So we've got to break that long-term downtrend and make a turn and go up. I was thinking that we would hit it sometime about the 880 mark, and we fell below it again. I still think that these markets are just tied up with all this coronavirus, and it's wreaking havoc everywhere. I'm hoping that this bottom that was set here that I've highlighted, you can see where that red line starts to your left, that we set a bottom back in about mid-March, and we did drop below it just about a week ago, but we came back real quick. I'm hoping this bottom, which is somewhere about the 838, 839 range, I'm hoping that this is a pretty strong bottom for us. I know whenever we hit this bottom the first time, China came in and they made some purchases. And that's why we saw the run up off of that bottom that started just to the left. And we made that run up to 880 and then started falling off because we didn't get any more sales. Well, now we hit that price again and China made more purchases. I don't think that this market's going to have the same run up to 880 that we did the first time that China made purchases, because everyone just got excited thinking, hey, they're starting to fulfill their commitments for phase one and starting to buy beans. I think it's going to take more purchases in order for the market to get real excited and run this price up again. I do think it can happen. Particularly, I think once Brazil is done and they've moved their beans from the harvest that they're just wrapping up, then it'll be our turn to shine. That might come closer to the fall whenever that happens. But I do think that eventually we're going to see these beans moving back up. If we can get anything north of 880 right now, that's a gift. So, you know, if we start making this move in the next week or so, I'd look at it as a gift. And if we moved up above 880, I'd grab some of that price action, because right now that's the name of the game. It's around 880 down to about 840 is the price range for beans. Looking at cotton planting pace, we got a report out of USDA as far as cotton's planting, and pace is going in the ground pretty fast. 13% done right now. 11% is where we are on a 5-year average, And last year at this time, we were 11% complete. So we're moving ahead of schedule. Arizona and California still running strong out there. That's a lot of Pima country. They usually get off the ground quicker. Next in line coming in, Texas 18% done. Louisiana's 11%, Alabama's 9%, Georgia's 8%. So we're getting off the ground. It'll really start taking off. We continue to get some good weather. This planting pace will take off just like it will with corn and with beans. Cotton prices did move up to the 60-cent level recently, and the reason is that the Chinese price charts made a double bottom. They moved lower in China, so they were thinking, okay, China's going to bounce, we're about to bounce, and this double bottom resulted in strength in New York City futures contracts for cotton. We nearly touched 60 cents. But I really don't think we're going to get above 60 cents until after we get everything in the ground in the Northern Hemisphere. I really don't look for cotton to make a strong move until after everything's planted and we see exactly how many acres are out there. The blessing right now is that we're closer to 60 cents than we are to 50 cents. So take that as a gift, because this market has really been hammered hard with this COVID-19. Looking at marketing right now, producers that have any cotton ground, I'd probably hold off. Rebounds are likely to happen after we get through planting, whenever we get into the growing season. Also, rebounds are likely once COVID-19 subsides. China is trying like crazy to rebuild its textile industry, and it was hit hard before down. They were losing a lot of textile mills over in China before.
Blake, you still there? You there, Blake? If y'all can hold with us just a second, Blake, we'll get him signed back on. Hold with us just a second.
All right. All right. Am I back, people?
You're back.
I'm back. All right. I'm sorry about that. Where did I leave off?
You were right there at the tail end of cotton is where I thought it was.
All right. Sounds good. Well, then hopefully, have you seen this slide? Oh, crap. I moved it to the How about this? Have y'all seen this one? Have we discussed this one? Cody?
What was the next one?
Marketing decisions?
That's one I think you were on right there.
All right, sounds good. Well, like I said, as far as marketing cotton right now, I would hold off. I think rebounds are going to come in after we get planting, after we get through COVID-19. Then I think we're going to get a bigger boost because China's textile industry was really devastated, but even before COVID-19, but it sure enough did pick up then. They're trying to rebuild it. They're going to be in the mood to buy more cotton. If you look at your cash sales with the loan premiums plus your LDP gains, that's putting cotton in about 63 to 66 cent range. You add on top of that your seed payment program, and that's going to bump your price even more. Now, these seed checks, they wouldn't come in until after the marketing year or at the end of the marketing year. But right now, we've got a price of about 63 to 66 cents. I wouldn't be hedging any cotton right now because it's not profitable to do so. Here's your cotton chart. You can see this morning it came in at 58.55. Definitely moved up to the upside in the past couple of weeks. I do think there's a hard top in here at 60 cents. This is the December contract. I don't think we're going to see a move above that right now. Other than that, I would just hold off. If we can break 60 cents, then maybe start looking at this market and trying to spot. But right now, I'm just not comfortable with trying to do it. I think COVID subsides, we could possibly move up to 65 real quick. Now, cattle, COVID-19 in the past. This big.
Blake, you still with us? Y'all hang with us. We apologize about this.
Probably gonna. What's that?
Oh, there you are. It cut out for a minute. I'm sorry.
All right. Hopefully, I'm back.
You're back.
Oh, all right. 2,200 workers in 48 states have been infected, and those numbers are probably going to go up. Some in the market are starting to suggest the meat packing plants are going to become the next disaster zones. That's scary. That's really scary with these packing plants because, number one, it's a bottleneck between the producer and the consumer, and you're talking about food supply here. The industry's kind of fighting between or looking at employee health versus the nation's food supply. There is a lawsuit making its way through the courts right now. It's accusing Smithfield Foods of not doing enough to protect the workers, their health at the plants in Missouri. Smithfield, of course, is denying these allegations. Some industry analysis are just suggesting that profits are just too high right now for these packers to pass up, and plants will not stay down for long. The USDA, they're kind of riding both sides of the fence. They recognize, it's the need to keep workers and inspectors safe that are in these packing plants, but they also recognize the food supply chain is a critical industry. These packers have to stay open, and at what cost, though? Employee health is something that they're saying, we've got to protect that, but we got to keep the nation's food supply open. This is a touchy situation right in here, one that's really, really, really shaky, and that's got me scared. The reaction to the plant shutdown or slowdown, last year we had one Tyson plant up in Holcomb, Kansas that shut down because of a fire, and it did disrupt the market, but the other plants were able to pick up slack real quick. This right now is different. We don't have flexibility if multiple plants go down, or even if they're restricted. We don't have the capacity to be able to just pick up the slack. We could even get to a point where the plants are just not physically capable of processing all the animals that are in line, and feedlots would have to slow down their placements. that would result in further sliding in feeder cattle prices and cash prices. This is something that is real touchy. And how do you handle it? Because again, we're talking about the food supply for the nation versus employee health. There's give and take there, and I'm not for sure the industry knows what direction it's going to go. Consumer prices, we could see them head to the upside pretty quick. We've just completed the 3rd week of reduced slaughter and production. Right now, we're looking at a 25% reduction in the meat production, right? As of right now, we've lost 25% of production. That's huge. The market's starting to project around May 1st. We're going to start seeing serious shortages develop at the retail meat counters. This is not going to be shortages like the very first weekend that I went to the grocery store and I didn't see any meat in the counter. We're talking week after week, the possibility of being short in terms of meat supplies, and it could start pretty quick. I think you're going to see some major hubs that are sure enough going to be short, and hopefully that's just spotty, but it could get serious pretty quick. Frozen meats could help out. The meat processing companies, they've got a restaurant line and they've got a grocery store line. Well, that restaurant line's closed. There's nothing going to restaurants. That shifted those supplies from the frozen meats to the grocery stores. So it's really going to be fresh meat. It's going to be a challenge coming up. Right now, pork appears to be the most in danger of facing shortages. Their frozen storage of pork decreased the most last month. Beef supplies right now look like they're at least okay. They were actually up 2%, but that could turn around real quick. Packer profits also coming into question. Senator Thune out of South Dakota has asked USDA and the Department of Justice to look into possible collusion here. In other words, them setting prices. They've suggested packers are pocketing about $600 per animal, while livestock producers are witnessing nothing but just falling prices. And they're pointing towards the box beef values versus the cash values here, suggesting box beef prices have increased $50 between May 12th and 23rd. That's a 25% increase. And during that same time period, cash dress prices fell 61 cents. So that's really what they're getting at is, hey, the Packers are really raking in the money and producers aren't getting any of it. So we may have some collusion going on. What we've got going on right now, it's unprecedented. The packing industry's been slowed or could even grind to a slower halt if COVID-19 cases increase. The impacts, they're going both up the chain to the consumer and down the chain to the producer. Consumers facing higher prices because plants just don't have the capacity to keep up with the processing rates. They're having to slow down because of workers getting COVID-19. They're having to close these plants and clean them, and some of them are closing indefinitely. Cattle producers receiving lower prices because packers can't buy as many cattle. They just don't have the capacity to buy them. So, of course, they're going to be paying lower prices. Again, it's a bottleneck here. Are packers making a killing right now? I think they probably are on what they kill. That for those that they are able to process, yes, they're making a ton of money on those heads. Are they manipulating the market? I really don't know. What I do know is that I would not want to be on that task force that had to determine if they're manipulating the market or not. It would be a nightmare to distinguish between what's manipulation and what is just this market that we've never seen before. What impact is that? Distinguishing between the two would be a nightmare. Even bigger things that I know, the industry's in jeopardy. There's problems here. Packers are going to have to pass the profits down the line to smaller producers. somehow they're going to have to get some of this money into producers' hands. Nationwide, smaller producers make up the bulk of the livestock production. Yeah, we've got some very, very large scale producers out there that sell a lot of cattle. But on average, we're looking at 34 head being the average herd size in Texas. So the industry's made up of a lot of small producers. If you let those smaller producers go under, the entire industry could fall apart. So this is kind of scary right now in terms of cattle, where we could go and what could happen, because this bottleneck at the packers, it's something that is, again, it traces back to food safety or food supply versus employee safety. And those two, they kind of seem at odds right now. If we want the supply to stay up, then we're going to have to put people's safety in jeopardy. And if we want to protect people's safety, we're going to suffer in terms of food supply. That's just the way that it's fallen out. And that's the scary issue, because it's a moral issue whenever you really do look at it. The rest of the fundamentals in the cattle industry, they actually look extremely bullish for a normal environment. On feed numbers were down 5.5% from a year ago. Placements in the most recent cattle on feed report down 22.1% from a year ago. Marketing's up 13.1%. Again, in a normal environment, these are extremely bullish. This isn't a normal time. So because of that, the report was kind of just ignored. It was really taken with a grain of salt. Longer term, live cattle have more bullish outlook. I do think that they do have potential. Feeder cattle, a little bit less optimistic. Grain futures, they're showing some signs of at least bottoming out, maybe showing some strength. That's going to be some headwinds for feed. Until we get packers more stable, feeder cattle are gonna tend towards weakness. We've got to get that packing industry back up, back running, and safe, so that we can demand these feeder cattle and push them along the chain. When all of this is over, whenever everything with coronavirus is done, I see even more volatility in the cash and the futures. I've talked to a lot of restaurant owners, and some in particular we've had in my neighborhood. Our neighborhood has asked, food trucks to come in on the weekends and provide a means of just getting out and eating. And I've talked to these owners and I've asked them, what did you have to do with all your product? And because a lot of them own ground-based restaurants, and they said, we've had to donate it all. We couldn't save it. It's a perishable product. We had to get rid of it. And so my question to them is, you're going to have some massive purchases whenever all of this is over with. And their answer is absolutely yes. Right down to every single thing that we could purchase food-wise, we're going to have to rebuy. There's still going to be a lot of at-home purchases, in my opinion, because I think consumers are going to return to restaurants in waves. Now, I do think we're going to have, after a week or two, we're going to have a huge wave of consumers coming back into restaurants. Probably, I've been saying for a couple of weeks now, there'll be a 2-hour wait at Taco Bell. But we're still going to have those at-home purchases, because I think people have gotten used to eating at home, and restaurants are going to ramp up their purchases. And I do think we're going to see a large number of people going to restaurants to eat at least 1 or 2 meals a week. With that, I think packers are going to have to run 24/7 just to keep up and replenish all of those supplies. It's really going to lead, I think, to some massive volatility moving forward once we come out of COVID-19. Here's your cattle charts. One thing that I would like for you to notice is, we've had some extreme volatility in here with feeder cattle, but notice in the short term, we've started kind of calming down. We got a little bit of an uptrend going on here, but at the same time, we could say we've got a downtrend. Prices are consolidating right in the middle between that high volatility. To me, that's saying that the market's kind of sitting back and wanting to see what's going to happen to this packing industry so that we know a direction. We're holding in the middle and we can either go up or down, but whenever we do, it's going to be very, very quick. So volatility here, I think, is going to return, and it's going to probably get pretty wild whenever it does. Right now, our trading range is 110 to 140. That's a $30 trading range, and that's huge in terms of cattle. But right now, it could go either direction. If the Packers somehow can move through this and can stay open, yes, I do think we have price strength, and we could go up to 140. My fear is that the packing industry has just started to feel the effects of COVID-19, and I'm scared we're going to drop. And so that one's really, really worrisome to me. Here's your August live cattle. It was sitting at $90.40 per 100 this morning. We do have a bottom in here just above 85 bucks. I think that that's more solid than the bottom that we have on the feeders. Yes, we are trending to the downside. I do think we are consolidating some. We're trying to say, you know, what direction are we going to go? I do think there's more potential to the upside. I've got 80 bucks to $1 per 100. You know, that's a pretty wide range. I tend more towards the upper end whenever it comes to live cattle right now. And, you know, I think that it's got more potential because we're seeing them coming out and it's closer to the consumer, and the packer can kill those. I think that we could see those prices going up. And whenever they do, that's going to drive your box beef prices up. So any questions that y'all may have out there right now for me, or just what have you heard?